You've been marking liquidity the wrong way. Hey traders, it's Trading Genius, and today we're diving deep into the world of liquidity, specifically tackling the question, how do you mark liquidity the right way? But before I continue, I want you to understand that there are different types of liquidity. Of course, there are elements of liquidities, but when I mean types of liquidities, specifically about highs and lows, there's what we call external liquidity and internal liquidity. Now, if you are keen to finding the right liquidity or where market is about to tackle or read exactly the spot where market is about to read, you need to identify your external liquidity and your internal liquidity. For example, let's say we have a chart like this, right? So this is exactly how you want to be outlining this particular liquidity, not like this. I see a lot of traders do something like this and call it a trend line liquidity. No, you don't do something like this, because in this case you don't know exactly when price is going to bounce back and and return. So you want to find out this spot, this particular spot where price is going to reject. So you don't mark your liquidity like this. This is totally wrong. Now what you do is you find your premium and discount, the external liquidity. Now what do I mean by the external liquidity? This is an external liquidity because it is the beginning of this original move. It is the beginning of this move. That's why we that's why I call that an external liquidity. Right? And now we have the external high and the external low. Once price starts retracing, this becomes what? An external low. Now anything inside of this range is what is called internal liquidity, and that is where you're supposed to be looking for a trade where price is going to start reversing. Now, I want you to understand that this is a premium and this is a discount. The upper side of this range is a premium, while the bottom is what? A discount. Now, how do you find exactly where price is going to start rejecting from the whole of this range? Well, we look at the external liquidity. First, we have this first internal liquidity. We've mapped our external liquidities, right? Then we have this first internal liquidity. And if you go to the lower time frame, we also have an internal liquidity here, which are relatively equal highs. If you go to the 1 minute time frame, if you go to the 1 hour time frame, you find that those are relatively equal highs, which price is supposed to read. Now, between this first liquidity and the second liquidity, which is price most likely going to reject from? Well, the answer is simple, because this other liquidity is in the premium. Now, I want you to take this key point. If price is selling, you can see the trend. The trend is what? Bearish, right? Now, if price is selling, expect price to always trade back to what? To a premium before selling. Very simple as that. Expect price to trade into a premium before selling. Now, if price is buying, expect price to trade into a discount before buying. So in this case, the trend is bearish. That means price is selling. So we are trading into what? A premium. Now, where's the premium? This middle line is the equilibrium. Now, if you look at this very well, this is exactly where you can find price rejecting from. Now, if we look at this particular markings, you can see that price is rejecting from exactly from this high. Whereas if you are marking your liquidity like this, you don't know where price is going to reject from. In this case, you are gambling. You're just making a bet that price is going to start rejecting from anywhere, right? But if you mark your liquidity this way, outline the external liquidities first, then outline the internal liquidity. In this case, you know exactly where price is going to sell from. So price selling from there is your what? Is your trade. Let's look at another example. It's a common way I see most traders mark their liquidities. They set this liquidity and call it a trend line liquidity, but with this kind of markings, you don't know exactly where price is going to reject from. Let's assume we're still somewhere here. You don't know where price is going to reject from. But when you take this out, you find what? The first thing is to find the external liquidities. So this is the external liquidity, that's the high, and this is the original high. Maybe I'm going to make a video specifically on how to identify external liquidities. So once you identify that, you find your range, the external high to the external low. Now, where are the internal liquidities? We have internal liquidity here. We also have internal liquidity here. Now you see, which of the liquidity do you expect price to reject from? The liquidity in the premium, of course. Like I said, if price is selling, since you can see the trend, we are bearish. If price is selling, you're looking for internal liquidities in the premium. So first we find the external liquidities and we mark out all the internal liquidities, and price is rejecting from there. After price takes that out, you can only anticipate one thing, which is what? A massive sell-off. And that is how you can find, or this is how you are supposed to be marking your liquidities as a day trader or a swing trader, to find out where price is going to reject from. All these levels are key areas on the chart. Let's look at another example. Now, looking at this chart, a lot of people mark their liquidities this way, as a trend line liquidity, but this is totally wrong, because if you mark a liquidity like this, you don't know exactly where price is going to start rejecting from. Well, so how do we do it? First, we take this thing off and identify the external low. This is our external low, and this is our external high. Like I said, don't worry about it. I'm going to make a video on how to identify these external highs and lows, or external liquidities. Now, first you want to find out your range. So this is our range. You can use the Fibonacci tool or the Gambox tool. And where is our internal liquidity? So first we have our internal liquidity here, relative equal lows. Of course, we also have an internal liquidity here. That's our liquidity. Now looking at this chart, which is the liquidity that price is likely going to start rejecting from? Of course, it's not this one. It's the liquidity that is in the what? Discount. Like I said, if price is buying, expect price to come to the discount and buy off. And if price is selling, expect price to come to the premium and sell off. So now this is exactly what you want to be looking for as a trader. You want to mark out your liquidities like this, find out the internal liquidity after marking out the external liquidities, and you can expect a reversal from this point onwards. You can expect a reversal from here. You pick a very good buy, you see you can make over 3,000 pips. You pick a good buy from here, you can make over 3,000 pips. Look at that, look at that buy, very massive. Now price have already created another external what low. We are hoping price will create another external high there. Then you find what your internal liquidities and expect price to do the exact same thing all over and over again. So the chart repeats itself. We just have to use the past data in order to read price. Stay tuned to this channel. Be rest assured that I will be creating and uploading more videos like this. And if you find this video insightful, please smash that subscribe button and like this video for more content like this. Thank you, and until next time, be safe.